All right, so we're going to talk about today about the fact, let me change the viewage real quick. The fact that 95% of America is broke, dead broke, or living on Uncle Sam, or than friends, family, neighbors. That's just facts. So most people are going to actually retire broke. Just facts. 29 trillion in debt is the US government. Most people are over their head. Most people are going to retire later and later in life because they didn't get ahead of it now. The reason they retire later and later in life because their expenses are this high, and if they retire now, even if they could, they would not be able to make it. I'm saying that to say this: the biggest problem is not retirement. People talk about wanting $1 million in retirement, blah, 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 blah. That's great, no. But here's success. Success does not mean you have to have $1 million. Success is when your income is significantly greater than your expenses. Can we agree that's successful? You can do whatever you want to do at that time. What if you can get people in a position where 10 years versus 30, 7 years versus 14, whatever the number is, they can be debt-free, done. And the biggest reason people are not debt-free, first reason is they don't know how. It's literally a maze. They don't know how to do it. They know they got to pay off debts, but man, they got this one hitting from this one. I mean, I've been there, I know. And I've used the software, so I know it works. So second reason is they know how, but they have no discipline. The spirit is willing, but the flesh is weak. Like people who want to work out, you want to get those six-pack and the guns, right? Some of you have the discipline to do it at home. If you don't have a six-pack, guess what that tells us? You don't have the discipline. So you hire a coach, or hey, if you want to do it yourself, you go online. You at least get a trajectory, but someone still has to do it with you. If you don't have the discipline and you see the value of getting out, and most people, just so you know, most people are motivated by fear of loss, not opportunity for gain. So most people, they're feeling the pressure of the debt. So this doctor that I work with, most people's plans are like his. Doesn't matter what your financial situation is, paying things off the way they're paying things off, it will take them a long time. So here's an opportunity where we use normally life insurance as a wealth creation vehicle. Now we're actually using it. Remember that Swiss Army knife? You know how it has so many different features, from the screwdriver to the knife. We're taking out the portion of the Swiss Army knife called an infinite banking policy that will now help them get out of debt. That is the purpose of this policy. Now, keep in mind, the infinite bank policy, when you get it, there's multiple policies. If you read Nelson Nash, it will take multiple policies to fulfill your goal of being able to finance your life. So when we set this up, maybe one policy is for retirement, maybe one policy is for getting out of debt. So we can set it up a couple of ways. So I'm going to show you how we do it. So I'm going to make some assumptions right now. And the idea is you build it in two ways. First things first, when we're normally asking clients about an IBC, they're thinking about, of course, they want to get retirement. We use that sheet that we talked about, the Haven Financial playbook, to book people that are looking for IULs, IBCs. That is your opportunity during the discovery to ask. You want to dig deep to see how I can help them, right? You're not only asking, income. I ask, hey, how much consumer debt do you have? Yeah, right? We ask those questions. I get a general idea, this much, this much. How much of that is credit cards? How much of that is a car, right? Do you have any personal loans? What is your house? How much total to pay it off? Okay. Now it's just a general. In order for the software to work, you have to get the percentage rates, right? What are you being charged for the house? The credit card, which if you don't have a rate, you can always assume about 25%, 28%, right? Personal loans about 15%, right? Homes 6 to 9, I've seen that, right? Same thing with cars. You can get some at 3 for homes, but same thing. So you can estimate if you don't know. But once you get that data, you can do two things. Yes, the client wants to get wealthy, but if you don't approach, or at least if you don't see the full picture of what you can do for the client based on their situation, it's almost like you're minimizing the value that you have and this policy can do for them. That's what you're doing. It's almost like you have a great policy. It's almost like people have those, it's like a Mercedes going out on the safari. It feels good, nice, but it could do so many other things, right? So meaning the vehicle, the machine you built for them, the IBC, is not being utilized, only this much of it. So let me fast forward and show you how I do it. All right, so let's talk about the IBC. So let's say we were talking to, I don't know, let's say Stephanie, and we went through, we got Stephanie's financial inventory. Once we get that, you have to first build a policy. Most people have something in mind as far as how much they're going to spend. Now, we know normally we're looking at $250 a month. $250 a month is what they think that they can expend. They don't want to spend more because it's going to be eating into maybe the future, eating into other budgets. What if we can have them reallocate some funds so that they can put more into the policy? That's one angle. Another angle is people buy when value exceeds price, right? What if I told you, hey, based on what we're seeing, hey, Stephanie, that house that you said you got 30 years on, that car, all those debts, if I could show you a way where you can get out of debt maybe half the time, like you're done. I mean, and maybe you could retire early, go do other things, do a different job, go after your dreams. I mean, and it costs you a little bit more than 250. How valuable would that be to you on a scale of 1 to 10? Oh, 10. You tell someone they can retire 10 years versus 30, you don't think they'll spend a little bit extra money? Think about that, guys. So that's the idea. But even if it was just the only amount that they have, whether it be 250 a month or more, you got to build a policy. I'm going to just build a fictitious one, even though this is quote unquote real. So I'm going to bring this over here so I can see everybody. All right. So I'm going to share my screen real quick. Where is it at? Okay. So I'm going to go to Lafayette because this is what I'll use right now. So agent.lic, we'll log in and book of business. All right. So we'll go in, you always hit this one, and we're going to just build a fake policy. So I'm going to build a policy based on what we're talking about. And again, it's okay that it's not the exact one, but if I showed someone what this does right now, it makes a big difference. So start case, and I'm going to just use myself. Actually, I'll use Stephanie. So Stephanie Snow, let's say Stephanie, you were 5, 6, I don't know, 1960. Okay. Good. Thank you, sir. And female. Okay. Whoops. Let's say you're in Georgia. I know you're not, but let's say. All right. And we're going to go whole life. And if some of you already know how to do this, great. All right. We're going to fast forward it. So I'm basically just going to build the policies I'm doing. And we know how to do it. If they're standard, I mean, you always choose standard, by the way, we know this. You go to the solve section and you put the amount that they're going to be paying. If they're doing monthly, put monthly. And base, let's say they're doing, I mean, we could do 250 a month. We could do that. I'll just make it conservative. Let's say they were doing 250 a month. Well, that's 3,000 a year. It isn't much, but hey, it is what it is. We always do 50-50 for now, and we're going to avoid MEC. Now, what does that mean? Again, this is not a training on how to set up the IBC, but just this is a good rule of thumb. It's always 50-50 base, 50-50 LPUA, unless we tell you different. And as far as the MEC, what years do you send? Normally, you choose the years of MEC until their age of retirement. So if I'm 50, I would choose a 15-year. And you only choose the MEC typically if you're going to give them a chance to add more money into the policy besides the monthly premium. So if you're not giving them a chance to add any more money into the policy, then you really don't need to choose a MEC. The MEC is just a term that you buy that inflates the policy so it can have a bigger death benefit to allow them to put more money in it. Because the rule, the IRS rule, the MEC test, is the death benefit, meaning if they died, how much the life insurance company will pay. The death benefit has to always be greater than the cash value growth. So if they were doing 250 a month, but then they stuff it in, an extra 1,000, it's going to grow past the amount that the death benefit is. And the IRS says if that happens, they will tax the person, which they lose the benefit of the IBC of not getting taxed. So to avoid that, that's why you add a term to it. So let's say I was 50, let's say it's a 15-year. And for this sake, I'm going to leave it alone. I'm going to assume I'm not doing anything. I'm going to assume I'm not doing anything. So we go view illustration, and it's popping up. And basically what's going to happen is the illustration will come up. You're going to save the illustration. Oh, wait a minute. Let's see what it says here. So I have to do a mix. So I have to do a term. So when that comes up, the system is telling me that there is no way around it. If I do 250 a month, it will grow past death benefit. So I'm going to do a 10-year term and now hit view, and the system will protect you. It will tell you whether it's going to mech or not. So after this downloads, I'm then going to go to another software. This software is the difference of what brings everything to play. So here we go. Where is it at? So this is the illustration. It pops up, another pop-up. It's about page 16. I'm looking at it. And if anything needs to change, it'll change it. So instead of 250, it's 288. The system will alter whatever needs to be altered. And that means that if they didn't alter it, it would have mech'd out. So the way I would have changed it, I would have added more term to it, but it is what it is. Right now, they're doing 288 a month. And that's a 288, 41 times 12. So that's about 3460 is what it is. So, whoops, that's the wrong one. That's why it looks weird. I apologize, guys. There we go. That's better. All right. So 3461 is the total premium. So 288 a month. So the cash, this is the death benefit, the cash value, and so forth. Time goes on, this is it. So I'm going to save this and just save it to my desktop. So I'm going to just put mock debt policy. I'm going to hit save. Boom. Now I'm going to go to another software. Where's it at? All right. Sorry, I got too many screens up, guys. Got to take this off so I can see which one I'm doing here. All right. Got off that. All right. So now I'm going to another software. I'm going to go to this software. This is the debt elimination. You don't say this is not debt consolidation. This is elimination. All right. Two different things because we don't do debt consolidation. So it's agencyrocket.com. There are variations of this, but they're all the same. There is a fee. Everyone has to have their own membership. Now, I'm going to cut this part off in the recording, but for now, you guys can use mine. Now, for now, if you have cases, meaning if you have a case, send it to me and I will help show you how to do it. This one, if you see it, I got to log in. Where is it at? Dang it. Where's that login? Yeah, debt action plan. Where is it at? Dang it. Log in. So I'm logged in. So we get a little discount through FFL. So I'm logged in and there's a couple different ones. Analyzer. So the debt action plan software is what I'm looking for. You have to first hit new scenario. You create a case for the client. New case. Let's just say I said it's a debt action plan stage. I mean, you got to choose some of this stuff. Let's just say it's lead, doesn't matter. I'm going to choose Stephanie Snow and case type is whole life. Yep. And let me move this up a little bit. Whoop, I'm missing one thing. The system, I always get this done a little bit ahead of time so that I don't have to get delayed at all. Stephanie Snow. I'm just going to put Stephanie@gmail.com. Okay. Save. All right. Boom. You hit save. It'll save the contact in there. Boom. So it takes them into this little portal. Debt action plan is what you're looking for. You want a new scenario. All right. Whoop, there we go. All right. So now this is where we start inputting the client's debt information. Let's say Stephanie we add their mortgage debt. We're going to put, Flagstaff home. Fixed term. And let's say it's, I don't know, 300,000. Interest rate. You put that, pretty simple. Monthly payment. Say it's 2,700 a month. I don't know, that's probably wrong. Let's say it's 1,900 a month with tax, title, whatever else. And how much over do they pay? They say they pay $100. Great. All right, you leave it alone. They have multiple homes. You just add another one and another one. You see, add mortgage debt, consumer debt, credit cards. Let it do its thing. All right, you're gonna put Chase, CC, revolving. Let's say they owe 20 grand. I don't know, be more conservative, 15 grand. Let's say most credit cards are 28%. And then payment of that 15 grand, and the system, and notice it calculates the minimum payment for you, which is cool because you don't have to be great at math for it. The client doesn't know. They'll say, well, it needs to be at least, bear with me here, 15,000. It needs to be at least $500 a month as your minimum payment because it does the math for you. How much do you actually pay, Mr. Jones? I pay $500. Got it. Right now, because things are just tight, whatever else. Okay. What about your second credit card? All right. I got a Capital One. And that one is I don't know, 6,000. That one is at 22%. And what's the minimum payment on that one? Oh yeah, it's like 173. Okay, got it. How much do you pay? I pay about 200 on that. Good. Now, you don't have to put all the other stuff because I'm not really going to use it. So at this point, you go to report, and this is where you upload the illustration that you just ran and created for the client. Click upload. I'm going to hit debt, find the illustration in your downloads, let it do its thing. It's thinking. And of course, meanwhile, we're talking to Mr. Jones. Mr. Jones, this is where you start, sharing stories. Remember, facts tell, stories sell. Because Mr. Jones, even if you explain all this stuff to him, it'll sound great. But when you tell him, Mr. Jones, a story, whether it's yours or someone of your partners, now it clicks for Mr. Jones. Hey, Mr. Jones, what I'm about to show you, we helped one of my clients or one of my partners helped a doctor who it was going to take 16.5 years, not only for his $60,000 debt, plus his business debt of $300,000 to get that paid off. With this same policy, Mr. Jones, he was able to get that done in 7.5 years. Nothing extra. Whoa, yeah. So you see the download, you see that generate report. So you make sure everything looks accurate. If you messed up, you can do it that way. You hit generate report, and then you're going to run the report. And then the report will download into your folder. So you download report. Now I'm going to share the report. Boom. So the share report, you put in, that's your name. You go down. Okay, Mr. Jones, right now with our plan, and it's all nice and neat, looks good. With our plan, Mr. Jones, it's going to save you $3,400 in interest payments, right? And you'll become debt-free in 17 years and 18 months. Boom. It just does it like that. Now, I'm going to stop there for a second. Just the fact of it being able to, like a Jarvis, tell someone based on what we've calculated, based on the monthly that you're doing right now, here's how you can get out of debt faster, Mr. Jones, by doing this policy. Isn't that valuable right now? Like if we stopped here, they got the number because I wouldn't have known how to do that. So you continue, Mr. Jones. Right now, here's your current plan. You got this for your home. This is the total interest you got. It'll take you 23 years to get out of debt completely, Mr. Jones. With our plan, now, again, it'll take you 17 years, 8 months. Not bad, right? Now, I did $250 a month. Truth is, you would do a lot more. You would do a lot more. $250 to knock out almost $500,000 of debt. They can do better, right? They can do better if you sell enough value. So how does it work? Well, here's how it works. They're going to make their minimum payments like they normally make them. In all that money that they were allocating, paying extra on the mortgage, extra on the credit card, they're not going to do that anymore. All that money will be going into the policy now. You have a new boss in town, a new vehicle, new machine that will be used, and it's building itself. It's like Legos. It's building itself. And when the machine is ready, boom, and I'm not got that debt like that. So they keep making their minimums, but here's the deal. And I'm telling this before I show you more. It was going to take them 17.5 years to pay off that debt. Oh, sorry, 23.5 years. So this is where the discipline comes in. This is like a set it and forget it. They're going to need your help in teaching them, maybe holding them accountable on what you planned. So if they were used to paying $2,000 a month in debt to credit cards and house payment, blah, blah, they're going to maintain paying $2,000 a month in debt. In expenses. But the difference is not all of that $2,000 per se will be going towards the debt. So if they're, for example, if 500 of that $2,000 was going towards a credit card, and the payments from their policy pay that credit card off, they're still going to be paying the $2,000 in expenses, but that 500 now will go towards the policy. That makes sense? So they'll still keep paying it. What accelerates the growth and allows them to do this is they lock in what they're doing. You have to sell them on the fact that your current plan will take you X amount of years, if not X amount of years. But if you do it this way, Not only will you do it quicker, but you'll have money at the bank. Because some people say, well, Mac, I could just use the cash and go pay it myself. Well, yeah, but remember this is where you got to train them on infinite banking. Remember, you pay for everything you buy. If you pay cash for things, you give up interest that you could have earned, or you borrow money, you pay someone else interest for the chance of using their money. So the credit card company will love it if you just gave them away your money, but now you got zero rate of return on your cash. And we've compared it, guys. People that just pay cash for the policy versus to their debts versus use this policy, they get out of debt faster this way, and they have more cash in the bank this way, more assets. Because of why? Compound interest. The money was compounding while they were paying them debt off. You see what I'm saying? You can't get that anywhere else. That's why this makes sense, because it compounds and it compounds and it compounds. So you got to understand the concept a little bit to be able to help, kind of walk them through the matrix. So here's how it works. It gives them a, where is it at? I do it right? Yep. Let me pause this for a second. I want to make sure that I did this illustration properly, because normally I do, okay, that's what I did wrong. So let me share this again. Everyone can do it however you want, but when I'm running these, you can do an avalanche where you pay the biggest first, or you can do a snowball, however you want to do it. Or you can do custom where you just do it, whatever. I believe the default is snowball. I didn't have time to look and see, but if I do snowball, let me see if it ends up being the same. I'm gonna generate report again and see if it ends up being the same. But so for some of you who don't know what snowball is that you knock out the smallest debt first, then you go to the next one, So download report, and let me try this one. New. All right, let's see what this one does here. All right, so let's go down. I'm just gonna show you what it looks like. Oops. Where is it at? My bad. Come on now. There it is. All right, so $6,000 on that Capital One credit card. It tells them right here, it'll take 2 years and 4 months to pay off that Capital One card. In essence, all it's going to happen is they'll be paying the policy. It'll take 2 years and 4 months for the policy to accrue enough cash. Once it accrues the cash that they estimate that the policy will have, and it will be sufficient for them to pay off that card. Is what they're saying. Because they're estimating, they're making their monthly payments and all that stuff. It's all that is already calculated into the system. They know this stuff. Once that's done, that same money that was being used, again, continues to get reallocated, the next debt, so forth and so on. Now, anyone having trouble with this? Does that make sense? If it doesn't, pop it in the chat, please. But I mean, guys, it's foolproof. You say at the end of it, Mr. Jones, instead of 30 years, instead of you, and here's what's cool. I guarantee you, people have money. They're putting money on their credit cards, extra. They're putting money extra on their mortgage. Why give your money away? That's my next video, by the way. But why are you giving your mortgage company extra money? Pop it into your policy, because that'll do a better job for you. So they have more money than $250 a month. They do. If they can afford a mortgage, they do. If they don't have $250 a month, guys, that's a problem. Here's what that means. They're overstretched as it is. But this is what I tell people. This is one of these preemptive strikes before you even present an option. I say, hey, Mr. Jones, that mortgage you got for $300,000. The good news is when you qualify for that, that means you qualify for this, because they never would have qualified you for that mortgage if you couldn't afford mortgage protection. You hear I said that? They never would have qualified you for your mortgage. Think about it. How would you qualify someone for a car if they can't afford auto insurance? Think about that. Like really think about that. It's a little bit different, but they wouldn't have ever qualified them, meaning that they have resources. How they allocate those resources, which may be good or bad, that's where you come in. So I'm telling you, they got money. Anyway, you show them the numbers. Mr. Jones, 17 and a half years, or in most cases, they're putting in $500 a month, $1,000 a month. Mr. Jones, here's a true story. There is a lady that's working a job she hates right now because she thought she had to wait till 65 to retire. We showed her this policy and what she could do, putting this money. She would be out of debt in like, I don't know, 10 years. She could retire at like 45. 45 or like, I don't know, 50, something like that. I forget what her exact age. Like for real, this is a true story. When I told her that, Mr. do you think she was excited? This is why people pay so much in their policy. This is why people put so much money in their cash bank. One thing we've been going, one angle has been to, yeah, the retirement, it looks great, some pie in the sky. But what if Mr. Jones had a chance to retire early, or like my doctor, at the end of the 7.5 years, what if he doesn't want to pay his house off? I said, Mr. Jones, Mr. Doctor, what if you want to sell your house, take the proceeds, go to Tahiti? You got 300,000 in cash that you got accruing, growing as an asset. How about that? Now he got both. So the debt plan, you explain it that way, you go through, and the truth is, I mean, this is where you kind of just, I don't want to say, you know, they're wise enough to help them kind of see what this will do for them. It's like a new machine. You know, guys ever bought a new car where they take you around, show you all the little features, but the main purpose of the car was to get you back and forth. The main purpose of this will be to not only get you out of debt, but make you cash rich. So you say, hey, Mr. Jones, 17 years will be complete debt free without any spending any additional money than what we're putting in right now. In 20 years, you'll have 81 grand in assets in this policy. 30 years, 442 grand in this policy, Mr. Jones. You were talking about generational wealth. Yeah, you were talking about getting out of debt, but wouldn't you love the chance to get out of debt, but use the same machine to build generational wealth? Mr. Jones, this will be 873,000 in assets, right? Because you add up all the things that they have, right? Because we know the death benefit has to always be greater than the cash value. So anyway, that's the long and the short of it, guys, is it's a tool we have. This thing has been around for a long time. People just don't use it. The tool just makes it prettier, if you will. But the basis of it is the same, is that I'm telling you, you're saving people's lives. People in America are going to go broke and die and work longer than they have to because they don't think that there's another way. And here's a way to do it. And it's going to require discipline, but the system doesn't work for them versus just paying it off. Now they get cash. That's what motivated me personally to do it. Is I hated the idea of just giving away money when I could have reallocated that same money. Instead of paying extra money on debts, I'm investing in debt. How is that going to give me a return? Nothing. Versus investing in the same $100 into leads that could give me $200, where now I have an extra $100 for leads. But what if I can invest in my policy and then use that money and pay it off and still have compounding growing? It does the best of both worlds. So guys, that's how the debt plan works. If you have questions, of course, let's connect.